Welcome to the What to Watch video update. This is a weekly video where I go through all the hundreds of charts that I look at and I pick out all those charts that I think are telling us something right now and I put them into one of three categories. Those things that are positive, those things that are negative, and those things that we're just keeping an eye on because they can have an impact on the S&P 500. And we're looking pretty negative right now. Now, a week ago when I did this video, I said, we're negative, maybe a little too negative. Well, I can say the same thing this week. Now, we spent Monday and Tuesday and Wednesday of this previous week trying to stabilize and actually bounce. We were up on the week, and then Thursday and Friday happened. We had a significant down day on Thursday, but we closed at the low for the previous Friday that I pointed out when I did the video a week ago. Well, then on Friday, we went down even more. And so, yeah, we're negative. You cannot deny that. It's like, okay, now we need to start to look for things. Number one is, when is the smart money going to come in and actually do some buying? They really haven't done that yet. Number two, okay, we are extreme negative, and that can produce some kind of an oversold bounce. And we're looking quite negative. In fact, I have just a few positive charts, and the rest of them are pretty much negative. And this will give us some ideas of what things to keep an eye on, not just in the S&P, but across the whole market. Because it's all about oil right now. Oil goes down, stocks go up. Oil goes up, stocks go down. That's pretty much what's driving the market. Not paying an awful lot of attention to the fundamentals, the economy, anything like that. Now, those things will become important at some point, but the market is still very emotionally driven by what's going on in the Middle East and what's happening with oil. That's producing fears about inflation and interest rates and a slowdown in economic growth. So it is feeding in that way on a fundamental picture. But when we try to go from day to day, sometimes even hour to hour, it's all about oil. Just for example, on Friday, we were looking fairly positive. The futures were up about 0.5%. This is about 6 or 7 hours before the market even gets ready to open. Then Europe opened. It started to go down a bit. Then oil started to go up. And then the futures went from being about 0.5% positive to about 0.5% negative. And then that produced a gap lower open on Friday. So it's whatever is happening, whatever headline comes out, whether it's interpreted as positive or negative. And that's rolling the dice right now. We don't know. I checked the news. This would be early Sunday morning, U.S. time, even earlier on the West Coast, a little bit later on the East Coast. And I don't see any major headlines happening that have to do other than just stories here and there about what's happening in the Middle East. But we have a buildup of troops. We're supposedly in this window right now where Obliteration Day has been postponed for the time being. They're going to try to talk about things. But you've got two completely different cultures that are dealing with things. You know, we've got our Western values, and you have the Iranian leadership values, and that's even a different brand of Islam where they have Shiite or Shia Islam, where they want to have as much chaos as possible to try to bring in their 12th Imam. That's their messianic figure that says can only come about if the world is in a complete mess at that time. And yeah, Iran's doing a pretty good job of that. And then you have the US and Israel together trying to get rid of that regime to the point where the people can then come out and overthrow the government and then put in the kind of government that they want. That's kind of the big picture view from what I see of things. But then, of course, you've got people that instead of asking questions, they state opinions, and you don't know what those facts are behind those opinions. That's why, in my whole approach, not only with the stock market, but in trying to evaluate things that are going on, I like to ask questions, not just make statements. You know, you can read memes, you can look at posts on Facebook or X or what have you, and say, yeah, I agree with that. But how factual is that? There's always variables that we don't know about. We can't put this into a real black and white type of scenario, and that makes it confusing. And that's why I look at so many different charts, because sometimes we get keyed off of things. We follow oil all the time, and I show it in every daily video that I do. And incidentally, all the charts that you see in here, I'll be updating them every day. And those are available. I'll have a link that you can look at to get to those particular videos. But yeah, we watch oil all the time. Now it's become a big issue, and there will become in the future, there'll be a point when oil isn't that big of a deal. Going back to before everything really erupted, everyone was kind of gold was where it was at. And then in the recent past, Bitcoin, I mean, it goes from one thing to the other. Then you got the mega cap stocks, the Magnificent Seven. Well, they haven't really performed as well. So things rotate around as to what the market's actually focusing on from day to day. But we just evaluate things. And I found that doing it intraday, there's too much noise there. Weekly, I do weekly videos, but that's too long. I found a day by day by day evaluation of things has been the best for really getting a feel for what's happening in the market. It's not just about looking at charts, it's looking at everything that's going on, taking in as much information as we can, and then saying, okay, we're positive, we're negative. So that's kind of my overall approach. But this week, we're asking the question. And that's what I do with this video. I start off by asking a question. Will the S&P 500 keep declining? Now, the S&P, as well as any stock, anything that's based on a price, it can only do three things. It can go up, it can go down, or it can stay the same. So yeah, that's not all that complicated. Just figuring out what it's likely to continue doing is kind of the tricky part. And this is being prepared for Monday, March 30th. Now, briefly, what I'll do, I'll go through a program that I have called the SPX Investing Program. It's a website, it's run through Substack. And even though once it gets up and going, I will be charging, right now it's all free. All you need is an email address. And to get to the full-blown program, you are going to have to provide payment information, but I don't charge you anything for that. And you get access to everything that I do, the videos every day, the weekly videos. I do a podcast, I do newsletters, I do additional videos that I don't even post publicly about trade ideas and different strategies that you might consider implementing. And so check that out and see if that's of interest to you. But once you set yourself up to be a free member, you'll get access to some things, but to get access to everything, you have to take that next step of actually becoming a paid member. But I'm not going to be charging you anything for now, for the foreseeable future. I'm thinking possibly June-ish or so. But I'll give you plenty of warning about that. Now, if you don't like all of it, plus, oh, another thing I want to mention, I like talking to people. You want to set up a time to maybe have a video call or something? I've actually found Google Meet works pretty good. I used to use Zoom, but it, for people that don't have a paid account, you're limited to 40 minutes. And I like to talk for however long I want to talk, whether it's just a few minutes or a few hours. So that's another thing. Feel free, set up a time we can talk about things. Okay, now if you just like the videos, but you want them right when they're available, that's also available on a separate website here with the link. And that eventually will be $19 a month. But right now, it's the same thing. You sign up for the free account, then you join this one. You have to provide your payment information, but I'm not charging anything for that. And then we do have the delayed access. Now, I used to post these on YouTube and Rumble, but it was just saturating my chart. I had all these videos out there, and YouTube, the algorithm didn't have any idea. It's like, okay, he's posting all this stuff that's, long form, not shorts. And I do that on purpose. I don't want the people that have short attention spans or just looking to be told what to do. I implement what's called critical thinking, where I guide you and I'll give you the best information I can and the best evidence that I can. But ultimately, it comes down to you making a decision about what you want to do. Then I do have newsletters. When that gets up and going, that'll be $8 a month. It's free for right now, and I'll give you plenty warning about that. What I do is I just take a transcript of the daily video that I do each day, and I put that into AI, and then that generates a newsletter, and then I go through and edit it. So you're getting a rundown in a very short format of everything that I cover. And it's not very long. You can usually read that pretty quickly. Then there is a free part that you have access to, and I post things there from time to time, but I'm also looking for feedback. So if you do become a free member, and you want, hey, what about this? What about that? Let me know. I'm an educator, and how I respond to things and how I try to give people what I think they want is first I ask the question myself, but then I need feedback for you to tell me about that as well. And then I do a podcast every day. That's also free. So check that out. It's usually 4, 5, 6 minutes long. Again, in a very short period of time, you can get a pretty much complete rundown on what's happening at any given time. Okay, so the positive side, not very long, just like when I did this a week ago. Now, one thing that actually improved, this is a little longer term, so it takes longer for this to change. This is a 10-day average of the highs and lows for the S&P. Now, we were coming down and we dropped below 50. That's negative. But as we were repairing things in Monday, Tuesday, and Wednesday session, and things were kind of calming down after being oversold a week ago, we actually came back up above 50. Now, this is not any really strong reading that we're getting right now, but to me, the line in the sand is if we're above 50, that's positive. If we're below 50, that's negative. And I had to try to find something positive here, but this is also longer term. So for right now, this is holding up. But if we continue to go down, then eventually this is going to start to go down as well. And then we have a long, very long term oscillator called a special K. And this is a weekly chart. And even though this line is coming down, we're actually still above the red line. If we cross down below the red line, that's what would turn this chart negative. When I get over to the negative side, the daily chart is negative. We're below the red line. Then we have some ratios that we're looking at because the Nasdaq 100, it's been getting hit, the Dow's been getting hit, and so our ratio over here is still staying fairly high. As long as we're above this red line and we're matching this up, this is the dot-com boom and then ultimate bust, and then we set that high again right at the end of 2021, and then we went into the bear market of 2022. Well, we've been able to stay above this, at least for the time being. And so I'm treating this as positive unless we start to really decline and drop below the red line. The same thing applies here with the QQQs, the NASDAQ 100 to IWM. Those are the small caps. Now, this ratio is weakening a little bit as the Qs have been underperforming lately, but we're still above the blue line. So I'm treating that as positive. And then the semiconductors, which they got hit this week too, like everything else, and the Dow got hit, but that's keeping our overall ratio positive for the time being. And then we still have a couple of days left in March, Monday and Tuesday, and that's another thing to be aware of is Monday and Tuesday you might see some craziness because it's the end of the quarter. Now we had the end of the quarter for options expiration a week ago. That was kind of a crazy day. We ended up going down pretty severely there. But now you have these money managers that run ETFs and hedge funds and mutual funds, and they're going to have their quarterly reports that they're going to have to send out. And so they might be doing some jockeying of positions in Monday and Tuesday session because they have to do that before the end of the quarter and we go into April. But we are dealing with positive seasonality, at least for now. Not as good as the first half of March, but given what the market's dealing with right now, we're actually hanging in there for the most part. Okay, now that's it. That's it for the positive side. Now let's go over to the negative side. And we did have a down week. Now, earlier on, you see here was Friday. Right after this is when I did this particular video a week ago. And then we had some positive news break out. The delay of Obliteration Day came, and that produced a higher income. But unfortunately, we set the high not too long after the open on Monday. And then it was all downhill from there. But we did have an up day on Monday. Now we had a lower open, but then we showed a little bit of bounce back here. And that's what we're seeing right now. We're not seeing an awful lot of conviction certain days like Monday, Tuesday, and Wednesday. Most of if we're up or down, it's coming from the gap. It's the futures that are reacting to what's happening in oil. And so we gapped up on Monday, but you can see we opened right about here. We closed over here. That's not all that much of a difference. And then we did have a lower open on Tuesday. But then here's where we closed. Not all that much of a difference either. Then we gapped up on Wednesday and then just kind of drifted down here. A lot of the upward move came from the gap. Then Thursday and Friday happened and we saw more conviction where we did have a lower open. There was an attempt to take prices back up, but then we drifted down here. And then on Thursday, this is where we closed at the low from the previous Friday. And I was thinking, okay, watch this as potential support. We might have a chance to bounce up off of that. And we were positive after the market closed and through the night. Then we started to drift negative because oil was going up, and that produced a lower open in Friday's session. And then we tried to stabilize a little bit here. And then later in the day, this is when the smart money comes in and starts to do things. That's when we saw things really drifting down, and we set the low pretty much at the close. So not too long after the open, we set the high, and then just about going into the close is when we set the low for the week. Now, in spite of all the craziness here, it feels like we're down a lot more than we are. Now, if you the definition of a pullback is 3, 4, 5%, and then might see more of a decline. That's 5, 6, 7, 8, 9%. When we actually go into a correction, that's when the closing value is 10% or more away from the previous high. In this case, it was an all-time high. Well, we're 8.74% away from that all-time high. We set the high right at the end of January, January 27th, and as of Friday's close, we're about 8.75% away from that. But the Dow, the Nasdaq, and Nasdaq 100, they're more than 10% away now. So they are actually in correction territory, where the S&P is holding up just a little bit better right now. Now, I'm also keeping track of this on an intraday basis. The percentages that I just mentioned, those are based on closing prices. I also like to keep track of intraday swings here. And when we had that intraday high and then to the low, which was also close to Friday's close, we are down 9.2%. Now, I put these on here and you move these lines just a little bit and the percentage changes a whole lot. But we're going to be watching this. If we go down over 10%, that changes a lot of the smart money thinking at that point. Okay, now we're in correction mode. And then we go down possibly 15. If we go down 20% on a closing basis, that's when we switch over and we're actually in a bear market. Now, we came close to that a year ago when we were coming down on an intraday basis. We were over 21% on an intraday basis. And then right when about the time we got to that 20% level, we hit some support, and then that's when the smart money started to come in. Even though it was really crazy there for a while, we hit a really strong support level, and then we were able to come up out of that. We don't know if that's what's going to happen this time or not, or if there's going to be more declines than what we've seen. But this is what we're watching for. We're watching the percentages, we're watching other support levels. We've broken a lot already, but there's still more that we're dealing with here. And then I'll be updating this in each daily video. Now, we're very negative, in fact, extreme negative with the fear and greed index. When we get below 25, that's when we start considering it's like, okay, everybody's pessimistic right now. Let's at least consider the idea of becoming optimistic. Well, we were there a week ago and we're still there now. We can hang down here for a while. This is not one of those times where we come down, have an extreme reading, and then boom, bounce up right out of that. We're dealing with geopolitical things. Or dealing with oil. We don't know how long this is going to last. Just a lot of different. This isn't just your typical market movement up and down, buy, sell, supply, and demand. There's forces that are acting on the market right now that have a big variable attached to them. And so for the time being, until it's proven otherwise, we are still extreme with sentiment. Then once a week, we get this report. When we're down below 2, that means we're negative and we're declining. These are different folks that make recommendations to buy or sell, or whether they're positive or negative on the market. It's called Investors Intelligence. It comes out once a week. The latest reading is at 1.57. That's below 2. So we're negative here. All right, and then the VIX. We closed above 30 on Friday. We're at 31.05 with the VIX. That's elevated fear. Whenever we get above 20, that's why I have a line right here. We see negative annualized returns historically. When we're below 20, that's when we see positive annualized returns. Well, we're climbing up here. And so at some point, is this going to freak out the market enough? I mean, notice how high we went a year ago. This is the old tariff tiff that happened. And we were getting up into the 50, even I think we hit 65 at one point around here. And then finally, that's when the market was kind of at a washout point. We're not seeing that kind of action, at least yet, and other than maybe short-term bounces here and there. And that's what I've been watching for. the point where the smart money says, okay, enough's enough. Now it's time to go in and buy. And that's usually when we hit a bottom and come up out of that. Hasn't happened yet. We don't know when it's going to happen. And it might still be some time down the road before that happens. And now this is a look at the 3 month average of the VIX and then doing a ratio with the daily VIX. I've been showing this chart. My gosh, I started showing this chart right at the end of 2025. This is right at the end of the year in the beginning of 2026. And we hit an extreme reading. And if you look, sometimes when we had an extreme reading, that produced some kind of a downward move. Other times, it really didn't have much of an impact. Well, we had the trigger signal at the end of the year, and then we went sideways for January and February. Now we're finally starting to go down here. Okay, we're a little removed from the actual spike itself, but still, this is continuing to go down for the time being. And this is a weekly chart. I also have a daily version of this that I don't have here, but when it's really moving, I'll start to show that again in the daily videos. And then intraday, we're switching down now to a shorter time frame. This is a growth to value ratio for a 10-minute intraday chart going down here. In positive environments, this ratio is going up and we're going down. That's negative. And then we have, this is a 30-minute intraday chart where the red, that's value, and the blue is growth. When we're more positive, the blue line will be above the red line. Well, we've been under the red line now with the blue line for quite a while, and they both got hit. Now, if you look back just a little bit here, on Thursday, the red line held up better than the blue line, but then they both ended up going down on Friday. And now the small cap growth to value ratio, this is actually positive. We're in an uptrend and we were doing pretty good. Now the index wasn't doing all that much. We've been kind of going sideways here, but it took a pretty big hit. Now the small caps, now this is the S&P 600 and they ended up being down, but we have another small cap index, the Russell 2000. It was actually up on the week. The small caps and mid caps are holding up there a little bit better, which is kind of strange because they don't like rising interest rates or an inflationary environment. But on a relative basis, compared to the S&P, the Dow, the Nasdaq 100, the mid caps and small caps are doing better currently, but that could change at any time. And then mid cap growth to value, this is not looking good at all here. And but there's another video that I do called a deep dive video, and I take 6 different indexes: the Dow, the S&P, the Nasdaq 100, mid caps and small caps, and I there's a technical score. The higher the value, the better looking that chart is from a technical perspective. And for the last 2 weeks, the mid caps have come in first place, even though they're not doing all that great themselves. They're just a little bit over 50. When we're really going up, we'll get a score of in the high 80s to low 90s. That's not what we're getting now. And we have our big growth areas like the Nasdaq and Nasdaq 100. They're coming in last currently. S&P growth to value ratio, this is the one that I pay most attention to, just not looking all that strong right now. And then we have some other growth to value ratios. The Qs to S&P below the moving average. Discretionary to S&P below the moving average. Large cap growth to large cap value below the moving average and decline. And all of these are declining currently. And then we look at the large caps, mid caps, and small caps. They're also all declining currently. This is another growth to value using a couple, or ratio that I do here, using a couple of ETFs. We were trying to stabilize. Now we were down already, but we were trying to stabilize here. Well, now we're starting to break a little bit more to the downside. Large cap growth. Now, when the market's really strong, this is going to be in a solid uptrend. And we've really started to roll over here, and we're below all the moving averages. And we're starting to see the 50-period moving average cross below the 200. That's my definition of a downtrend. It's a moving average crossover. And so we're below all the moving averages. We're going down. The moving averages are coming down. And now we've generated a death cross. Okay, then just to see if we're seeing the same thing across a number of different indexes and ETFs, and we look at some growth to value ratios here, where for a long time we were going sideways with the S&P, but this was showing a negative divergence. It was trying to stabilize. Now it's starting to go back down. Another growth to value ratio going down. Another growth to value ratio going down. And then we look at large cap growth to the S&P. Now, I was pointing this out as somewhat positive because really you have to follow this blue area in here. It's not an exact measurement. We had a couple of previous highs with this particular ratio. We set a high back in 2020. We set another high in 2021, which ended up being a double top. And then we went into the bear market of 2022. We finally bottomed and we came up out of that. Now, what was once resistance here, we were finally able to break through that. Now, once we get above that, this now becomes support. And so we came down here and we've tested it a number of times. Well, we're starting to break down a little bit. But this is also a Fibonacci retracement. We're also drawing lines here based on previous highs. But so it's not an exact science when you look at this chart. I would follow the blue area. And if we really start to come down from that, yeah, that's going to be more negative. Discretionary intraday chart, not doing really good right now. And then this is an end of day chart where we see the discretionary to staples ratio. That's been going sideways, tried to bounce up a little bit, went down. And then discretionary to staples, another measurement here. It had been stabilizing, now showing some weakness. And now I look at the relationship here between the S&P and then this ratio in the middle. When we're up in the blue area, which is where we spend most of the time, that means they're going in the same direction at the same time. We were actually starting to go in opposite directions. Now we're coming back where it's more neutral currently. And we look at the Qs to S&P a little different way here. This is growth to growth and value. We were trying to bounce back up here, but now we're starting to show some more weakness. And this is also back to neutral. When we look at the S&P to a ratio of the Qs to S&P, where we tend to spend a lot of time in the blue area, we actually got down into the red area. Then this is similar to the chart that was on the positive side with a 10-day average of the highs and lows. Well, this is a 5-day highs and lows average across the broader market, not just the S&P. We're below zero and declining. So we're seeing more broad market weakness currently. That's a little bit longer term. Then this is even longer term. This is a 50-period moving average of the highs and lows for the S&P. We're coming down. That's negative. And then another growth to value ratio, which was actually holding up a little better. No, not right now. And then this is the daily chart. We are below the 200-day moving average. We're coming down here. Now we're starting to come into April, and these are the pivot points for April that are already on the chart before we even get to that point. And unless we see a pretty hefty bounce in Monday and Tuesday session, we're going to probably start the month below this P, which is the pivot. When we're above the pivot, that's considered positive. When we're below the pivot, that's considered negative. Right now, we broke through all of the previous pivot points here, and we're kind of in free fall as far as this chart is concerned. So we have to look at other charts to see if we can get some support as we're coming down. And then you can see down at the bottom, we spent most of the days this past week below average with volume. Then this is another chart, just very basic, in that we were going sideways. We were starting to come down. We finally broke below the December low. That's kind of a short-term negative. Well, then we kept going down even more than that, and we actually broke down below the November low, and then we fell under the 200-day moving average. That's even more negative. So again, we're kind of in free fall with this right now. And then there was a gap. This is a year ago almost now. It was at the beginning of May. Some really positive news came out, and the market just really gapped up here. Now we came back down, but didn't fill this gap. And there's this saying in technical analysis that gaps like to be filled. Now, that's not always true, but this might be an area to keep an eye on. Now, we're still a ways away from that, but if we get down to this level, we just want to keep an eye on this. Now, the advanced decline line for the S&P, yeah, it's taken a hit here, but we're still above these longer term moving averages. So bigger picture, we're still positive. Shorter term, yeah, this is negative. And then I have a 10-day advanced decline oscillator where we had become extreme negative. We were starting, in fact, this went up after Thursday. The decline that you see here was when we dropped back down below zero, and that's why this is treated as negative. So we're seeing a lot of the current values here have been below zero, so that's negative overall. We look at the new highs and new lows. Now, the new highs have actually done okay. We're actually seeing a bit of an expansion here, but we're also seeing a bit of an expansion of the new lows. Now, the 5-day moving average of what's happening between the red and the green, that's still positive, but starting to weaken. We were going down with the 10-day moving average. That's trying to come back up, but now it's leveling off after the decline that we had on Friday. Then I have 3 smart money indicators, and these are negative. Accumulation distribution, this is longer term. Below the red line, both are declining. That's negative. Then in a shorter term look here, We have what's called the boom indicator. Well, we're negative here. We're declining below the moving average, but we also drop down below this green line, which typically in the recent past, that has been an extreme reading. Now you go back to a year ago and we got even lower than where we're at now. So until this proves itself to us, we're still treating this as negative. Then smart money indicator number two is the chicken money flow. We're negative here with the red line going down. That's negative. And we have smart money indicator number three, the chicken oscillator. We're not only negative here, we are extreme negative, but we've been extreme negative already. We get extreme negative when we get down to this pinkish line. Now we're all the way down to this more purple line and still going down for the time being. So at some point, you might think, okay, this is rather climactic here. You'd think that people would start to come in and buy. I mean, we didn't even get this low when we were totally tanking a year ago with the whole tariff tiff. We're getting a lower reading right now because this has been more of a sustained decline where this is all freak out that lasted a relatively short period of time. We're negative with the vortex. The red line's going up, the green line's going down. Now we look at the short-term trend. I use a thing called the ADX, average directional movement. I focus mainly on the intermediate term, but I like to keep an eye on the short term. Now, when we get above 40, that's when this starts to look extreme. We're above 40. Not only is the ADX, the black line above 40, but the red line, the sell, that's above 40 as well. So it's quite oversold. You have to kind of think about it in reverse psychology here. This is going up. That means we've been going down pretty fast in the short term. So this could suggest that we're oversold and due for some kind of a bounce. Now, then this is the one I look at. This is the intermediate term. This is still going up, showing a strengthening trend. The red line's already above 40, but we're not quite there yet with the black line. But this is still negative. Now, this is a weekly chart, and we're negative here. We turned up, we're crossing above the moving average, red line going up, green line going down. So we're negative in the short term, intermediate term, and here with the long-term weekly chart as well. Now, I usually don't show this, but these are moving averages on the S&P itself. And this is an exponential moving average. They move faster than simple moving averages. Well, we're coming down and getting an extreme reading in the short term. We're really close to getting an extreme reading in the intermediate term. This could actually end up being positive. It's negative until proven otherwise, because we're going down. But when we get down here, this is quite often where we see an oversold bounce that may happen. And if we do get a bounce, we'll be evaluating that. What's the strength like? How's growth doing versus value? Is the smart money coming in? Are we seeing a pickup in volume? Those are the things that we watch for. We don't just watch price. Oh, it's going up. I think I'll buy. No, we have to evaluate that and see if it has some staying power. Because we were looking that way a week ago, and there really wasn't a lot of power behind it. We were up and we were stabilizing, but then we just kind of stopped, and then everything switched back to negative, and we went down on Thursday and Friday. Now, this is the condition of the short-term trend. Everything's going down right now. This is the 20-period simple and exponential moving averages. Short-term trend is negative. Then we look at the intermediate-term trend based on 50 periods. We're going down there. We're below the 50-period simple and exponential moving averages. We're below the 100-period moving averages. Now, this is why I use separate charts, because this looks like just fireworks or something, or a waterfall, a rainbow waterfall here. We're below all the moving averages. And the longer we stay down here, the shorter moving averages, they move faster. What we're concerned about is the 50-period moving average here, which is in green. It's still up here a little bit. We don't want that to cross below the 200. That's when we would see a death cross with the longer term trend turning to negative. Then, just to give us some perspective, we're negative, but possibly extreme because we're below this blue dashed line with the 20 period, 50 period moving averages, and we're also below the 200-day moving average. Then I wasn't using this chart for a while because we had some short-term support here. These are anchored weighted moving averages, and we were just kind of in no man's land, and I couldn't see a real point to, add another line here. Well, this is about where we closed on Friday. So this may be some support that's coming into the market. Now, if we break below that, yeah, things are going to be more negative. We may be able to see some kind of a bounce up from this particular moving average. Then the short-term averages, prices below all the lines are going down. Alligator, this is more intermediate term. Below the lines, all the lines are going down. The guppy moving average ribbon, Short term coming down faster than the longer term. That's negative. And now this is new because I need to break these out and start looking at some really long-term moving averages because we're starting to hit some of this. And I have a 200, 250, 300, 400, 500-day moving average. This also produces its own little rainbow that's been holding up okay. But if we start coming down deeper into this, that's going to turn this longer term rainbow more negative. And you see, the last time it was negative, this was in the bear market of 2022. You notice with the tariff tiff a year ago, we weren't down here long enough to really change these lines. That's because they're very long term moving averages. We're going to be watching to see what the lines themselves begin to do. And you can see we were slowing down a little bit here as the 200 and 250 were getting a little bit closer to each other. Those now we're going back to the short term now. These are the stocks inside of the S&P. Remember the 20 period exponential moving average? That's on the index itself. These are all the stocks inside of the S&P 500, and we're extreme negative with those that are above their 20 period moving averages. We're also almost extreme negative with the 50 period moving average study, 100 period moving average study, and 200. And there's a gentleman out there who I really respect, and I watch his videos on YouTube. He thinks this is the silliest thing ever. It's like, okay, you have a number of this here. It's the angle of attack that you have to be concerned about. And I agree with that. I look at that in other ways, but I still think these are useful studies just to give us an idea of what's happening. So I would respectfully disagree with him in his current conclusion. Okay, and now we're getting far away from the 20 period moving average. That's what the boom indicator measures here. And when we get too far away, price has a tendency to snap back. Well, we've been far away for a while. It hasn't snapped back yet. We're also far away from the 50 period moving average. And when we cross below zero, that's where we're turning more negative since we're below the 200-day moving average. Then we have the McClellan oscillator. Now it's been doing a lot right below zero, so this is negative overall. And when the McClellan oscillator is below zero, we decline with the summation index. This is a little bit longer term based on the previous chart's values. We're declining here based on price, but then we got thrown a bit of a curveball. We were bouncing back up Monday, Tuesday, and Wednesday just enough to turn the volume up. Well, after Thursday and Friday, we're back to going down now. So I want these to be confirming each other. Price is the most important, but we also want to keep an eye on what's volume doing as well. Then we look at a broader market, NYSE McClellan oscillator here. We're also declining below zero. We continue to decline based on price and volume with the summation index. That's negative. Now, this is actually, I could have put this on the positive side. I apologize. This is the Swanland trading oscillator, and it's actually going up right now. I don't count this as a primary indicator, but I don't count it as a secondary indicator. I have it like right in between the two. There are some times when this chart gives us very, very good signals. There are other times when this chart gives us terrible signals. It'd be nice to know which ones were which before they happen, but we only know this in retrospect really here. But this is actually positive. And now we have some PMOs, the price momentum oscillator, and then a bunch of studies for all of the stocks in the S&P that go with it. We're getting down to an extreme reading with the percent of PMOs inside the S&P that are rising. We're only at 20% now. And we're coming back down, but we're not quite extreme with the buy signals. Only 21% of stocks are generating buy signals. And then the PMOs that are above zero, we are declining as we're seeing more prices cross below zero inside of the S&P based on the PMO. Then parabolic SCR, this is the daily chart. We have the dots on top. That's negative. Here's the weekly chart. Also, the dots are on top. That's negative. All of our momentum indicators here. Short term, then I have 3 intermediate term, 2 long term. They're all going down. And then I have an additional one here, the Copic curve. That's also negative. Now, this happened a week ago. There's a percent B indicator because we closed down below the lower band. This is a weekly chart. This happened a week ago. We closed down below the lower band. And now here we are a week later, still below the lower band. This tends to not happen very long. And when it does, it can either produce some kind of a bounce. It has to rectify itself somehow. Are we going to come up with price to wear off this extreme reading? Is the Bollinger Band going to come down and catch up with price? Or is it going to be a combination of the two? And that's what we're going to be watching for. But this usually doesn't last all that long. And you can see we were getting extreme readings a year ago when we were really coming down here. But again, this didn't last for very long before we came up out of that. So we'll be watching this as an oversold condition. And then we're going down with the bullish percent index. These are all the point and figure buy or sell signals. When we're below 50, that means there's more sell signals being generated. And then I put a moving average on here and everything is declining. That's negative. We also have a bullish percent index on the on the NYSE. We're below 50. We were improving, but now we're starting to go back down. There's also another BPI on the Nasdaq 100 below 50 and declining. That's negative. If we get down to this red line, this is usually where we look extreme, but look at what we did a year ago. We went way down here. We got down to like 5% buy signals inside the NASDAQ 100 there for a while. Now, this is also a chart I usually don't show in this video. It's called the balance of power. When we're above zero and going up, the balance of power is positive. When we're below zero and going down, the balance of power is negative. But this is also an oscillator. And you can see here in the history on this particular chart, we haven't had as negative as a reading as we're having right now. This could also suggest an oversold bounce. And then the TTM squeeze continuing to go down. It was actually improving. It turned to a lighter shade of red. Now it's darker again. Below this black line, this also suggests we're oversold. And these are point and figure charts. This is the daily chart where we've had a descending triple bottom breakdown. That was generated just on Friday, where we're seeing some more deterioration. When we see X's, those are buy signals. When we see O's, those are sell signals. We're seeing an abundance of sell signals right now. Then we have a weekly point and figure chart. That's also adding some more red circles here. Then we had a quadruple bottom breakdown. That was generated way back on the 2nd of March. We've just been adding more circles to it as the market's been going down. So this is negative here. This is the daily special K chart. Remember where the weekly one was positive? Well, we're comfortably negative here on the daily side. And we're coming down here. This is a weekly chart of the S&P. You can see the lower highs, lower lows. We're still hanging out slightly above this pivot point. So this might act as a support level. It's still 150 points away from where we're at right now, but we'll see if we even come down to this point and touch that. Then I'm starting to break out the old Fibonacci retracement charts. These are some of the new ones. I hadn't used these in quite a while, so I had to update them. This is now I have Fibonacci retracements for the NASDAQ, for the NASDAQ 100. I'm going to be focusing on S&P 500 because we might not get it from the S&P. We might get it from another index, so we want to keep an eye on those. But this is we measure this from the low a year ago in April to the all-time high set right at the end of January, and then this matches the Fibonacci retracement levels. We're not there yet, but it's time to start looking at these charts in case we do continue to decline and see if one of these areas may provide support. Now, this is a different version. This is based on Fibonacci numbers, and if you know much about that, it's patterns in nature, and you take 1 and 3 and add it together. And you come up with this golden ratio, and this is supposed to predict human behavior, and it also predicts patterns that you see in the forest and in gardens and cauliflower and all that stuff. Okay, this is very simple. We went to the low set in 2022, the all-time high that was set at the end of January, and you just break it up into 4 chunks. Well, that's the green area, okay? And we're coming down close to that. That would be a 25% retracement here, all right? Now, that's long-term. Now we go a little bit shorter. We set another significant low in 2023. That's the maroon line that you see here, going all the way to the top. Okay, we broke below the short-term blue line, and we're headed down towards this more maroon line. We're wondering if this is going to provide support. We'd held there for a little while and then broke down below it this past week with the blue line. Now we're wondering, are we going to come down to the maroon line? And if we even are more negative, we might come all the way down to the green line. And then what are we going to do if we hit that point? Is that going to be support, or are we going to keep going down? Advanced decline line across all the different indexes. We're below the moving averages, so these are leaning more negative. The Dow is below both the 50 and 200-day moving averages, even though it's still in an uptrend. You can see the red line starting to roll over here. And we're breaking below support here with the NASDAQ. And there's really not much here. We might have to kick over into the pivot points that are already plotted here for April to see if some kind of support ends up happening. And the same thing is true with the NASDAQ 100 here. So we're seeing some pretty negative price action. Momentum for the NASDAQ 100 is negative. This is a weekly chart. A week ago when I did this, we're like, okay, we're kind of matching up with this previous intro week low Well, we broke below that. So that's more negative from a longer term perspective. And we've been hanging around this trend channel going back to 2009 for a long time. Well, now we're starting to break down below it. This is the second level of QQQ stocks. A lot of the AI stocks are in here. We've been holding up fairly well. We were below the 50-day moving average. We're still in an uptrend, but now we're starting to break below the 200-day moving average, and that happened on Friday. So a lot of damage was done there. Small caps here. They were down on Friday, but you see how they're holding up. They're not quite down to their 200-day moving average yet, and they're still in an uptrend. This is the S&P 600. Then we have the Russell 2000 small caps. The 200-day moving average is still holding. We came down to this, and then we're able to come up from it. Now, as strange as this sounds, we're watching this to see, are we going to hold on to this 200-day moving average? Now, this is not a small cap environment. They don't like rising interest rates. They don't want inflation to be going up. That's when small caps don't do well. But this is hanging in there better than some of our other indexes right now. So we're just kind of watching this. In fact, here's a ratio, small caps to large caps. When this is going up, that means the small caps are outperforming and they're actually holding up fairly well. Mid caps came down close to their 200-day moving average. This is the strongest looking index right now. You see a lot of sideways action, and then we kind of slipped lower here, where the Nasdaq, S&P, they've been just in free fall lately here. So this is actually holding up a little bit better. We'll be watching this 200-day moving average to see if it holds up. And then this is a broad market look. The total U.S. stock ETF, we are below the 200-day moving average and declining. FANG index, all the components are listed here. These are all the names that everybody hears about and wants to own, except right now. We are in a downtrend. We couldn't get above the 50-day moving average, and now we Thursday and Friday we started to break below these previous lows. This is not a sign of strength. And then we've been seeing the ratio, the S&P to FANG index, it was actually getting down to neutral here for a while. Now it's coming back up into the blue area. That means that the S&P and the ratio down here, they're moving in the same direction at the same time. Unfortunately, they're both down right now. That's why the correlation is getting stronger. Then this is short term. These are short term indicators, and I go through all these in the daily videos that I do. I don't show them in this video, but we have an RSI here. That's extreme negative. A longer term stochastic, that's extreme negative. A Stoch RSI, that's extreme negative. So on a short term basis, the Magnificent 7 ETF, it's oversold. But I was showing you this video a week ago. Maybe we'll get a bounce out of this. Well, not much. We just kind of stayed below all the moving averages and really didn't change. And then Thursday and Friday happened and we're turning back to much more negative. This is another ratio where we lost some support, but we're right at other support. A ratio of the Magnificent 7 to non-Magnificent 7. Those are a couple of ETFs. We were holding out at this 50% retracement. This goes back a year ago when we set a low to the all-time high that was set right at the end of October. And we're hanging down here. Now we've broken below that, but we're at the 61.8% retracement level. If this doesn't hold, we've got a lot of free space here to go down, and that would be a 100% retracement. Not very positive. Okay, and then we look at the semiconductors. Now, they've been holding up fairly well, but even they're getting hit. Software's been getting really hit now because of AI. It's like, who needs software? We can just have AI generate all of our apps now. Well, the semiconductors, that's hardware that's needed, and that's been doing better. And that's when we're seeing this ratio really going up. We just want to keep an eye on this. And as we've been coming down here with the semis coming down after going up with this ratio, the correlation, it spends most of its time strongly correlated with each other, either up or down. We were actually going in opposite directions. Now it's starting to get a little bit more aligned. Unfortunately, it's because we're declining. Here's the semiconductors. We're just a little bit below the 200-day moving average with the Dow Jones Semiconductor Index. And this is the weekly chart here. We're declining below this blue line here, and that's typically where we see more meaningful declines. This is a weekly chart. And we have the SMH Semiconductor ETF. It's not down to its 200-day moving average. It's holding up a little bit better, but it is below its 50-day moving average. But on the weekly side, it's also declining down longer term. And then we look at the semi to tech ratio. This is actually holding up. Okay, it was actually up a little bit on Friday. And it's not that semis were up. It's that they were down less than tech on Friday. So that actually helped the ratio overall. Now we're looking at this, and we've been positive on this for quite a while, but now we're leaning a little bit more negative. This is a stock to bond ratio. And when we're above the rainbow and going up, that means the market is anticipating a soft landing, meaning no recession. That's kind of in doubt right now. Now, other charts that we look at, we're not really seeing a concern about a recession at this point. We haven't received any economic data. Now, we're going to start getting some of that economic data that's going to include data from the start of Epic Fury. Really, it was February 28th, but the first day the market had a chance to react to it was the Monday in March there. We're seeing a general breakdown here. Now, we've seen that before, and then it finally recovered and we came up out of that. Are we going to continue to go down here, or is it going to turn more negative than what we're seeing? If we drop down here, then that means hard landing, which typically means a recession. This is that same ratio, but inverted. This is showing how bonds are now outperforming stocks. Oil, that's what everybody's freaked out about right now. We closed at 101.18. This is the West Texas light crude oil. This is more US based, and this is what we produce all different kinds of stuff, and there's all different kinds of oil and so forth. There's also Brent sweet crude, which that's more, it might be processed in the US, but it's also used more internationally here. This is what's freaking the markets out right now because of the Strait of Hormuz, because Iran feels they control that area, and geographically they do. But then Oman, which is right across about the 20-mile stretch from one side to the other, actually they have a bigger portion of the Strait of Hormuz. But yet Iran came out this past week and said, "Oh, $1 million a ship, baby. We'll let you through." Okay, and that couldn't even be taken seriously here. But this is what's been causing the problems. We'll have to see how the futures open up here Sunday evening. Now, I have a number of different charts to show what's going on with oil. No, normally, I wouldn't even show these charts, but because oil's the big focus now, well, you can see oil, the price is going up. We have a VIX for the oil. That's been going up too, as oil's been going up. Well, so a lot more volatility here. And then this is an energy to S&P ratio, and then comparing it with oil. Yeah, energy, that's been the strong sector. It was up this past week. And so, and that's a more defensive move. That's why we're going down in other areas of the market. Then energy to bonds, energy's really outperforming here. Now, this is a newer one. This is US to the 10-year yield, kind of like what I just showed you, but this is just plotting them both. And you can clearly see as oil goes up, the 10-year yield goes up too. I don't have a correlation or anything like that on here. I just wanted to show you, yeah, you can clearly see they're going in the same bloody direction. So keep an eye on interest rates. Keep an eye on oil. If they're both going down, then that might be more positive for stocks. This is an intraday chart. You can see the wide here. This is when oil really started to go up. About that time is when the S&P really started to go down. This is an intraday chart here. And now we typically get down to a lower reading here with the correlation where they're going in opposite directions, but they kind of stabilized a little bit here with the correlation study. And then this is Brent crude. That's more international. West Texas, that's more internal to the US. They had gotten a little bit out of sync with each other here, but now, at least and I can only look at closing values here. These are end of day indexes. They don't really give you an open, high, low, close. At least it's all that useful. Then the things that we're just keeping an eye on here. We want to keep an eye on jobless claims. This has been holding up quite well. We're actually not seeing a lot of initial jobless claims. And whoops. Okay, there should have been another chart after this. Okay, the continuing claims are also declining. That may pop up here in a minute. Now, another thing that's been kind of positive is that as we've been going down the toilet here, we've been below average with volume. So when you see a decrease in volume and a decrease in price, that leans a little bit more positive. But still, going down is going down. Okay, and then our ratios really aren't doing all that much. The risk on to risk off ratio, earlier in the week, this was going up. Thursday and Friday, it came back down. Then high beta to low beta, same thing here. We were showing some improvement. Then it started to come down on Thursday and Friday. The staples to tech ratio, staples are more defensive. We want this ratio to go down, and right now it's going up. And then value to tech, we want this ratio to go down. Right now it's going up. And then S&P to utilities, we want this ratio to go up, and right now it's going down. So it's kind of the opposite of what we want. I could have put these on the negative side, but it's like join the 150 other charts that are already there. Then staples to S&P. All right, this is going up. That's more negative. That means the S&P is underperforming. The 10-year yield, we're going up here, and this is freaking the markets out. In fact, we're seeing a golden cross here with the 10-year yield. Now, lately, over the last few years, if we get to the 4.5% level, that's when the market's been freaking out. Well, that's before we had what's happening right now. So we're trying to figure out, and we'll only know this over a period of time, what is the critical point where stocks really freak out because interest rates are going up. In the past, it's been 8%, 7%, 6.5%. Then over the last year or two, based on the environment that we've been in, we've been around the 4.5% level. So this is relatively fluid, but it also takes a while to figure this out as well. Then this is the inflation concerns according to the market. Short term, they're pretty freaked out. A couple of weeks ago when I did this video, we were not concerned at all. Then everything broke loose, and this ratio has really been going up. In fact, we're starting to generate a golden cross. This is cash to the 3 to 7 year bond. When this goes up, that means the market's concerned about inflation and interest rates. But are we seeing that in other charts? Okay, here, glad you asked. This is tips to 3 to 7 year bonds, a little further out, a little longer term. We're not really seeing any problems drifting over into this part. And this is even longer out still. Now it's going up here, but it's not, skyrocketing up. So we'll watch these day by day. I'll be updating them each day in the daily video that I do. And if they start to settle down, that's going to be more positive for the market. If these continue to go up, yeah, that's going to be more negative for the market. We want to keep an eye on the spread between risky and not as risky bonds. We were concerned as this was coming down. That means there's more fear coming into the bond market. We've actually stabilized right now. So we've seen a little bit of an improvement there. And then inflation expectations. What does the market say? There's an ETF for that. We're actually down a little bit in Friday's session. We're not really moving with a lot of conviction currently. And then we keep an eye on some different ratios. And we're seeing late deterioration here. Discretionary to staples weighted. Now, weighted because Amazon and Tesla are included in that. And people don't think that's fair because they're also mega cap stocks. We were coming down, we stabilized, now we're dropping off. Now we use an equal weighted version of discretionary to staples, coming down, stabilized, decline. Tech to utilities, coming down, stabilized, decline. This one's holding up better. Biotech to healthcare, because healthcare is getting shot too. Even though it's more of a defensive area, it's actually it's going down, so it's keeping this ratio more in line. Then we look at hotels to utilities, coming down, bouncing back up, now starting to decline. So we're seeing weakness here. This is kind of a pseudo growth versus value way of looking at the market. Then we look at what are called bellwether industries here. Semiconductors are doing okay. They're not really breaking to the downside. We are seeing some stabilization and then a breakdown here with the home builders. The transports were doing better. Now they're not. Retail's been holding up okay, but even it's been getting hit lately. And this is actually encouraging. The regional banks, these are the smaller banks, not showing a lot of strength, but not falling off a cliff either. If we start seeing banks having troubles, that's going to get us into another great financial crisis like we saw in 2008 into 2009. And we're really hoping that doesn't happen. I mean, to deal with a war and banking problems at the same time. Yeah, the perma bears just love what's happening now because no matter what happens, disaster is always around the corner. I like to be a perma realist and say, okay, things happen, and then we adjust and evaluate. Actually, evaluate, then adjust. Okay, U.S. to international stocks. U.S. stocks are holding up on a relative basis a little bit better. And then momentum stocks, again, not really showing much. If this starts to go up, even as we're going down, you can't see it here now, but we were actually still doing okay with this ratio as we were going down a year ago. If this starts to go up, that's going to give us hope that at some point we might find some kind of a bottom and be able to come up out of that. We're not really seeing all that decisive of a reading right now. And then now that I actually stopped talking about this for a while, there is a correlation sometimes of Bitcoin to the NASDAQ 100, and that relationship is getting strong again after it got down to neutral. Well, unfortunately, they're both going down right now. That's why the correlation is pretty strong. And then we're keeping an eye on the private credit. This has to do with the AI trade and all the money that's being loaned out there, that people are going to be able to pay it back. Are they going to get a good return? And this is the drop off that we've seen It hasn't been doing all that great, but it really started to show some weakness when we go back to the beginning of 2026. And then we look at it on a ratio basis with the S&P. It started to underperform almost a year ago. It started to really go down here. This is a concern, and we just are keeping an eye on this, but we've been watching this for a while. And then this is longer term. It won't be official until after Tuesday because this is a monthly chart. A lot of times with the staples to SPY ratio, when we get to a really low reading like this, unfortunately, that can mean a top in the market. So we'll see if this continues to go up. I have a question mark here because we closed down here, right about where I have my pointer. So we were off of the highs here with this, but we want to watch this longer term. Unfortunately, since it's a monthly chart, it's not going to be official until we go to May. So, yeah, it'd be nice. I mean, we can look back and go, oh, should have done this, should have done that. But when you're trying to make shorter term decisions and you're using it with a monthly chart, and you've got a lot of the month still left, it's harder to use these. And then the dollar is back above 100, both on the daily chart and on the weekly chart, which the market likes weaker dollars. Okay, and then here are the pivot points for Monday's session. They're available on the YouTube community tab. I also include them in a daily newsletter and video that I do on the website. Then we have this Hindenburg Omen. We haven't had any additional spikes, so if things stay the way they are right now, but this is after Thursday. Friday hasn't been calculated into this. If we don't have any additional spikes, this will fall off. Now, April 3rd, the market's going to be closed on Friday for Good Friday. So really, this should be April 2nd, but this is not an absolute date. You just go 30 calendar days from when the last spike was generated, kind of, sort of. A little bit before, a little bit after, so it's kind of a loose definition there. But the important thing is that we had the initial spike way back on January 29th, and we've seen a series of confirmation spikes after that. That's what's concerning us. But we're just trying to figure out, is this chart going to go away in a week, or are we still going to be talking about it? Thank you. I really hope you found this helpful. I hope you have a wonderful weekend, and I will talk to you in the next video.